looks like you're live. You're on.
Howdy, howdy, howdy. I'm Oliver Rennick. We're getting things rolling here. It's a moving festival here. A lot of people in the seat, a lot of people on set, but we're now back on track. Welcome to week 2. This is Chicago Future of Finance. Market's in a nice little grind right now. S&P 500 is recovering some lost ground from the last couple days. Pretty decent little start to the session, and maybe a nice close here. We got an hour left to see if S&P 500 can keep pushing. We're kind of flirting with 6450 right now. Little weakness in crypto over the weekend. Obviously, it wasn't great to see Bitcoin get hit and give back some of the post-Fed excitement. We're going to talk about some of that intraday activity and some of the softness that's crept in around the edges. But generally, stocks still look pretty good. I got a few little changes I'm going to make on the risk radar later on in the show because there are a few developments I think that are somewhat surprising. We had a big bounce back in the dollar yesterday. It's given some of that back here today. So some of that post-Powell dovishness is still hanging around in markets. But right now, I think that the main focus is the S&P 500 holding strong. We saw a little bit of bond back and forth, a little chop there as well. But generally, the message seems to be after Jackson Hole that if you're looking for rate cuts, you're likely to get some. The question is if they'll come in September. Whether or not that is a likelihood is up for debate, but something that we'll put on the back burner for now. Let's get into the charts and let's look at the intraday activity. We got a great show coming up, by the way. A lot of good guests are going to be here. We're going to continue to push into the future of finance as Chicago sees it, which is very much about the advisor world. We've got Bob Oros joining us, representing Hightower after an incredible run, 50 deals and $1 trillion in advisory AUM, which is pretty amazing. He'll be joining us on set to talk about how he sees the advisor world and what comes next. Brent Kochuba is going to join me here off the top in a moment to talk about the intraday action, look at the gamma levels and what kind of trades are forming in individual stocks. We've also got Chang McGillivray joining us at the back end of the show, a $7 billion growing RIA of Kingsview Partners. So connecting those big buy-side folks, Bob and Sean, with some of the stuff happening on the sell side. Jeff Chang joins us from Vest today, a growing story about buffer ETFs and using options within ETFs, a very popular format that's grown quite a bit, $50 billion in Vest really leading the charge on that front. So we got a lot of great conversations, and that's not even to talk about the gamble. John Najarian rejoins me as we go into the event contract space, talk about some of the pop culture stuff and look at some unusual options activity in addition to what is being bet on Kalshi, Poly Market, and more. If you had the odds of Taylor Swift and Travis Kelce getting married, then I guess you're getting paid off a little bit. Let's go to Brent and let's talk some levels. Let's talk some gamma. Mr. Kochuba joins us from SpotGamma, and it looks pretty decent right now, Brent. I mean, I'm pulling up your platform right now. If we go and we look at the feed that I'm looking at, you're going to see that we're at the highs of the day right now. You've got this kind of steady grind up and to the right. It's not a big, great session here, but I feel like given Bitcoin's weakness on Saturday and Sunday, and then yesterday too, that stocks firming up here is probably reassuring to most folks. What do you think, Brent?
Yeah, I'd agree with that. All is quiet on the Midwestern front, I guess you would say, given your Chicago position there. And I would say one thing that also surprised me that you didn't mention yet is the whole Lisa Cook situation with the Fed and Trump firing her. Last night, futures got a little bit squirrely after that kind of announcement came out. But if you look at rates and the odds of a rate cut, that seems to be pretty much a lock. The fact that the market is not following through, Bitcoin's not following through, I think is a little bit concerning for people because they're starting to question, the narrative around how solid is this rate cut? Is it actually a thing that we need and want right now? And like you said too, Bitcoin and crypto as a signal of risk taking, certainly cooling off at this moment. I think most of us would have assumed that if we got rate cut and we got kind of that 1% Powell immediate response after Friday, that there would be a little bit more follow through today. And so the bottom line here is that a lot rests on NVIDIA's shoulders tomorrow night. 35% of the S&P 500 is tied to stocks related to this AI trade, right? So kind of the Mag 7 names. Not only that, NVIDIA is 7.5% of the S&P 500 and 14% of the NASDAQ, right? So this stock is literally like the S&P itself is almost reporting earnings. And you can see short-term vols or short-dated vols are really elevated for Thursday and Friday, which take into account, this NVIDIA earnings. So if that AI story falls apart, then I think that there's a big component or a big part of the equity market that is going to start to loosen its bid, right? It's going to have a hard time maintaining a bid. And so to your point, just at the top of the show right here, we're grinding along right now. The volatility expectations for today and tomorrow pre-NVIDIA are very small. There's a giant zero DT position right now at 64.55 that the market's just kind of pulling into right now at the moment. And so, the short-dated positions are there to suppress volatility, and things are really, I think, going to open up after NVIDIA tomorrow night.
All right, I'm looking right now as we're pulling back the clock here. That kind of up and to the right, the path for today seems pretty decent. So, yeah. Brent, okay, tell me about that wall there, because I see that we're kind of in the bluish, kind of purple territory above the red. Does that mean we're trying to break free of some of that downward drag?
Yeah, that purple zone that you see there is what we call positive dealer gamma, and this comes from proprietary data that we actually source from the CBOE, and then we model it and we figure out how buy-side traders are positioned. So what you see in this case is dealers have positive gamma to hedge. Positive gamma means volatility suppression, and the market tends to find the biggest strikes on the board. So if you hover over that strike at the top left, that big blue bar, you'll see what we call a 99th percentile gamma strike. That's also just a zero DT strike. So that is a huge level for today. And as 60+% of SPX volumes are zero DTE, well, that is a big strike for a lot of volume, right? A lot of volume is tied kind of to that level. A lot of liquidity is tied to that level. And I would just say overall as well, that into tomorrow, traders are not expecting much volatility either, again, because of the fact that the catalyst is NVIDIA earnings on Wednesday night, right? So today and tomorrow, you would anticipate it being a fairly low vol session, and then obviously the fireworks tomorrow night. Now, all of this is in context to calls really losing a bid. We put this on X earlier, but if you go over to our scanner tool, you'll find that what has been happening lately is a rotation from that's a button right there. What's been happening is a rotation from actually just do this.
Should I filter this, rank it somehow?
Yeah, it'll be a little bit easier if you just go to the vol dashboard. So the second button down, we can just shortcut this thing. One more button down there.
Yeah, there we go.
There you go.
Yep.
All right, so what you're seeing on your screen here is fixed strike vol for the S&P 500. So what is the vol doing at every single strike? Now, if you see there's a little bit of a darker shade of green there, right where your cursor is for the 28th and 29th, this is that elevated vol that is in place, right, due to NVIDIA earnings tomorrow night, right? Now, what's been happening under the surface here is that calls, that is strikes to the upside, they've been losing implied vol. That vol has been coming down a little bit due to some call filling, but also what has been more interesting to me is we're starting to see a bid to puts. It's not a significant bid to puts, but skew is starting to shift back ahead of NVIDIA earnings, which I think is very interesting because you would have expected there had been to be more call demand when Powell said, hey, all right, everybody, I think we're going to get a rate cut, and rates are all leaning towards getting a cut, and the betting markets and everyone else.
It's balancing out? It's kind of balancing more, or what?
I think people are starting to hedge is what I see. And I think if NVIDIA misses, right, or even let's just say, they just kind of come in line and it's just kind of like a whatever report, right? We do risk, I think, sliding to the downside because I think NVIDIA is more holding things up right now as opposed to holding things back, if that makes sense.
Okay. Now, the potential then look, I'll say that I've kind of been in the camp that NVIDIA matters more to some extent. And I'm a fundamentalist, I guess, at heart, where profits and the AI stuff is the more kind of true reason for how we got here. But that's certainly debatable. I know there's a lot of people that put a lot of, credence into the Fed story. That hasn't really been my necessary view. I feel like that's a little bit, it gets kind of political in some ways. I know it's important, obviously. But the fact that, look, here every day, top options volume, right after the indexes, I'm looking at it as NVIDIA itself. And that hasn't changed. That hasn't budged. So, how can it not be such a huge piece of this story, if not the number one?
I totally agree with you. And the other thing about this is slightly off the options topic, but I think it's interesting, right? When ChatGPT 5 came out, it was kind of a flop, and I think a lot of people now, if you just look at Twitter and what's happening on X, right? The narrative has shifted away from like AI as this accelerant to like ChatGPT being this symbol of like a short-term top. It's like the most, the latest algo or the latest iteration of the LLMs, right, didn't get us the incremental value that we were all looking for. And so I think people are now starting to say, hey, like, you got to show us something, like prove something here. And if NVIDIA is not putting up those numbers that show that CapEx and all this other stuff is still expanding, then you have not only NVIDIA giving some back, but then to your point, you got Tesla, Apple, all these other names that are related to that AI story kind of giving some back. And that's most of the market now, right? That is such a big part of the market. And so that losing that narrative is important. You also see that narrative being lost in Bitcoin as well, right? With MicroStrategy and issuing more shares, and very quickly these themes that were so prevalent in the bullish case and pushing the market forward, they're taking some shots right now, right? And so people need to start to believe in something, and NVIDIA can't help that, but I think it's up to them to kind of reinstill confidence in the story and the prevailing theme of the market.
Okay. I'm going to go to the chart here for a second, just because I want to get some more perspective on the potential for upside, and I guess to the same kind of tone to the general downside as well, because we talked about some of the areas where we want to sort of break free. This is a simplified chart. If we're able to get out of here, Brent, do you feel that we've got momentum for a push? I mean, we're not far from all-time highs here. This is so important, is that, I like to watch over the weekends. I'm like 100% crypto. That's all I watch. And then yesterday with Bitcoin coming off and Master coming off pretty hard, there was a possibility where we came in today and maybe you would see some of the high flyers drop. Maybe you would see a hood get hit. Maybe you would see some of the other ones, but we haven't really gotten that. Instead, it seems like the broad market is finding some form of leadership every day. So, the light is green on my risk radar for stocks. It seems like we're in pretty decent shape as far as the equity index goes.
Yeah, and the downside story is very simple. If we lose 6,400, then you get the onset of what's called negative gamma. So put values start to pick up, hedging flows push the market lower, and then you're also likely to see vol jump a lot if 6,400 gives way. So you often hear about Vanna flows, right? So negative Vanna, or the ability for VIX to spike, that creates downside hedging flows in the market that pushes the market down quite a bit. So 6,400 is risk off. And then to the upside, the first strike you got to look at is 6,505, which is the big JP Morgan collar strike into September. That's such a well-known strike at a big round number of basically 6,500. So I think what happens if NVIDIA is in line or beats, then you start to see the S&P just kind of grind along into mid-September. We've been calling this a zombie because it's likely to be a very low volatility regime, just something that grinds ahead. And then you see people step back out on the risk spectrum. So chasing some of the AI stocks, maybe getting back into crypto, leaning into small caps a little bit more, kind of chasing the stuff that has less volatility suppression, so to speak. And that could be kind of a final blow off top into September options expiration and FOMC.
Love that perspective. Less of the vol suppression forces when you get outside the main index, where all of the options, a lot of the options action is happening, because the Russell's been looking pretty solid. Few of those kind of other rotation style trades are pretty solid as well. So look, today could definitely have been worse. Last point real quick, Brent.
Agreed. Yeah, I would just say there's this theme that people think that the small caps, we could rotate out of that crowded breadth in the NASDAQ and S&P, and small caps could take the baton. But I'm of the view if NVIDIA misses, like, IWM can't save us, right? So I think even the small cap is dependent on that as well.
You either get one NVIDIA or like a billion small caps.
That's right.
There's only 2,000. There's only 2,000. So, all right, nice. Great stuff, Brent. Appreciate it very much, sir. Fun thing about doing a new kind of technological show and flying by the seat of our pants with other people doing podcasts here and 300 guys trained behind us. Sometimes the tech gets a little bit tricky, but the good news is we get to blow breaks. And I love blowing breaks. Let's go to Jeff Chang joining us from Vest. This is a must-have conversation when we're doing a show from the floor of SIBO, which is the home of options, and a show that's geared largely to also advisors in addition to our retail audience and trader audience and pro-tail audience, because Vest is, and Jeff, you guys have been a foremost leader on asset class, I guess we'll call it, of targeted outcomes, buffer funds, and more. Thanks for being here, Jeff.
Yeah, great to be here. Good to see you again, Oliver.
So tell me, is when you started this business, did you think it was going to grow as fast as it is right now? You guys are supervising or attached to at least 50 billion in AUM right now, right?
Yeah, I mean, we started in 2012, so it was a slow, long slog until, and then recently, like in the last couple of years, the target outcome space really hockey sticked.
Right.
I think the advisor community really saw the benefits associated with downside protection, and especially the benefits of options in that case as well.
Yeah, that hockey stick is what I'm referring to, which is appropriate for an options conversation. There's a lot of convexity in the chart of your AUM. Why is that? Is it because advisors want to have an array of options? Literally, do they see what individuals are doing as the options boom post COVID, kind of force advisors to think about how to use options in their own approach and their own business model?
Yeah, that's a great question. So a lot of these strategies have been around for years, right? Like the first structure note of, let's say, in the buffer strategy, was introduced over 30 years ago. In 2010, there were buffer annuities. And by introducing it in fund form, whether through ETFs or mutual funds, it solved a lot of the drawbacks that may have come with, other types of delivery vehicles, even options themselves. I think Cerulli Associates did a research piece several years ago on why don't, let's say, financial advisors or investors, for that matter, hedge using options. And the two biggest reasons actually surprised us. The number one reason was compliance, meaning the compliance burden sometimes with trading options, and scalability, meaning, when you buy a stock, you buy an ETF, you can put in your portfolio and it'll kind of do its thing. Maybe you rebalance once a quarter, but with an option, you have to trade it every, let's say, 30 days, 60 days. But by having it inside an ETF or a fund, we're able to trade that option now for the investor. And so now it can be scaled, right? It can be, you can rebalance once a quarter. You can put it in an asset allocation framework. So while these solutions have been around for over 30 years, even like as simple as a put spread collar has been around, by packaging, by combining, let's say, something like ETF technology and option technology, then investors can really easily access these types of benefits without having to trade them themselves.
The thing that the part, all that feels like it reconciles easily in my head. The part that makes me scratch a little bit is when you have a market that's been so persistent and a bull market that's been so long running, and every dip that keeps getting bought, where's the demand coming from for folks that are more interested in protecting downside, which is largely what these are about? Correct me if I'm wrong, because if there is a big, strong rip to the upside, the price of those options is going to work against you a little bit if you don't realize that downside. What's the mindset? Who is the client that that really wants that as their priority, to make sure that if things do get hit, that they're going to be in better shape than they would in a broad market fund?
Yeah, that's an excellent question, and I'll answer in two parts. The first part is, I would say this: when is the best time to buy protection? When the market is already, corrected 20% down, or when we're still near all-time highs? Like, you don't buy, like flood insurance after the flood, right?
Yeah.
You definitely don't buy life insurance after you die. So I always ask the question, like, when is the best time to buy protection? At all-time highs or when it's already fallen? And so this is why we've seen a tremendous amount of growth now, is because people have seen that, 2023, 2024, the first half of 2025 had been great for equities. And whether or not, you look at where valuations are, a lot, some people have a lot of times views that a lot of the earnings growth is already baked into price. So why not protect those gains? And if you're wrong, there's still sufficient upside to actually get there. I think the second component is kind of the backdrop of what we saw in 2022. Like, unless you were managing money 40 years ago during times of inflation, you never really experienced what we saw in 2022, where interest rates went up and stocks and bonds both went down at the same time. And this is what we're seeing, is this massive shift of people saying we need to diversify our risk management and not just rely on diversification asset allocation. Because what happens if 2022 happens again, stocks and bonds both drop at the same time? What in your portfolio is going to save you if that happens again? That's the question, right? And this is where hedging, which has been around for years, for decades, why hasn't that been so adopted? Going back to the reasons I talked about: scalability, compliance, this is where those solutions get solved in the backdrop of the threat of inflation, whether through geopolitical risks or tariff, right?
So that's an important point there on bonds and stocks together, because if you look at this just compared to like a equity exposure, and Cliff Asness's AQR came out pretty hard with an analysis against buffer funds, where he said, according to their research, 85% of buffer funds underperformed according to their criteria of time that they surveyed compared to broad market fund. But if you then wrap in the bond side and you say, okay, well, your bonds are getting hit as well, then to some extent, these products also address part of the bond portfolio. Is that some of the argument there, Jeff?
Yeah, that's right. I mean, the problem with trying to compare a particular strategy versus a kind of historical ex post, because you essentially have the luxury of knowing historical data, right? And it's a very common kind of methodology of saying that, hey, you know what, I'll mix equity and cash. Well, first off, investors are not going to just put their money in cash and equities as investment. Their existing portfolios are stocks and bonds, right? That's what you're comparing to, because you want to give your clients actionable advice, how to actionably improve the actual investments within their portfolio, not theoretics, right? Like, hey, hypothetical with historical data, like how, if you had invested in this much cash, well, that's because you have the benefit of hindsight. And this is why people kind of can see through that. They can see through that. They can say, hey, I'm starting with a 60-40 portfolio. If I introduce this, I can make that better. That is ultimately the benefit of options in creating a hedging in that way. And there's so many other things that just not just that, but also income generation and so on and so forth. I think some of the main flaws is saying, comparing that you would be better off investing in S&P. Well, that's true. These were never intended to outperform the S&P, because guess what? These types of strategies of downside protection are for the investors that are in the stay rich game, not the get rich game, right?
Fair enough.
Most of the investors, like, if you want to get rich, I don't know, invest in crypto, right? Like, I can name a ton of other things that you can do, but that's not the purpose here. The purpose is for those types of investors that are wanting to protect their wealth, they're near retirement or at retirement, and looking at their portfolio, not a hypothetical for investment that has the benefit of hindsight. What do I have actually in my portfolio that I can improve with, let's say, a hedge strategy, hedged equity, or even a buffer fund for that matter?
I know a lot of that advisor world too is about preserving wealth. We're doing an AI component to this show, Jeff, where some blocks I get help from some AI. I got some help from the AI on this one. I'm going to pull up a little Q&A here. So here's the question that I asked, which was, how do the buffer ETFs compare to structured products, hedged equity funds, option overlays? Because you've got competition in some of these other assets. And it said, I'll read it pretty quick. Buffer ETFs give you downside protection in exchange for capped upside. We talked about that. They remove the counterparty risk associated with structured notes. Unlike hedge equity or overlay funds, they're rules-based, so there's no manager discretion. Okay, that part I think we all agree on. That's a good point. Against pure index invest in the underperforming bull markets, but keep nervous clients from bailing during drawdowns. But here's what I thought was interesting from the AI. The AI points out there's hidden alpha in timing, though, which is about rolling into a fresh series after volatility spikes reset the buffer and the upside. Give me a last thought on that, though, because isn't there a timing element to some degree, too, when the buffers are specifically set for durations of time on how I am, as an investor, locked into that fund during that time?
Yeah, I mean, there's definitely an ability to do to have better performance if you time the trade correctly. However, I would say if you're looking at it strategically as opposed to tactically, these types of strategies can really benefit a portfolio. Yeah, absolutely. You can seek better performance by tactically timing the trade, which we've seen several clients and investors do those types of trades. So you get the best of both. We actually have strategies that allow people to both act strategically and tactically. So not saying one's better than the other. I think it's great, especially we build these types of tools because these are the things that investors want, to be able to express a tactical or even be able to invest strategically. Both of them are available. I think both of them are great.
Jeff, let's continue the conversation again. Appreciate the catch up. Thanks for being here.
Great to see you again. Great to see you again.
Thanks for tuning in. Absolutely. Jeff Chang, fast. We're going to take a short break, get a little breather, catch up. We'll be right back.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. SIBO is on a 5-year growth streak making billions. And its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance.
Join me, Oliver Rennick, from SIBO, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago, Future of Finance. I'm Oliver Rennick. Joining us today is a pretty big dog in the advisor world. I'm joined by Bob Oros, former CEO and current board member at Hightower Advisors, the biggest RIA here in Chicago. Bob, it's great to have you on the show.
Really great to be here.
It's a fun setting because we've got the options guys behind us, and while the show is about options, we were just talking to Jeff Chang, who's using options to create these buffered products for advisors, but really the show is about bringing the advisor side of Chicago together with the option side of Chicago. Hightower is the biggest advisor. Tell me just kind of first, because you went on an incredible run. 7 years at Hightower?
Almost 7 years, yeah.
Okay, 7 years and over 50 deals and
56, but who's counting?
56. And if you go assets under supervision or advisory, over $1 trillion now at Hightower.
That's correct.
That's after the NEPC deal.
Yeah.
Now,
when I hear you say it, it's almost like, did we really do that? But we did.
So how do you feel now, and kind of where do you go when you you go through such a massive period of growth like that? I mean, for you, still looking over the board of the company itself, how would you describe where it's at today?
Well, I think you can never stand still. So, I heard the word former CEO. I'm still getting used to that. This is month 3 of sort of being out of the day-to-day fire. But it was just so much fun to grow. Like I tell people, growth is never undervalued growth, because it really is a lifeblood of a company. And we had hyper growth through some really interesting periods. I mean, you think about 2019 to 2025, we had a pandemic. We had unprecedented rate increases going on. So we had a lot of things to navigate. But you have to continue to evolve as a company, and especially when you're doubling every couple of years. So, things that work today aren't going to work tomorrow as you get to bigger and bigger size. So for us, it's been constant evolution, making sure we have the right balance of investment in growth, but also investment in infrastructure and risk, and making sure all those things around the company that have to work in concert are scaling properly.
When you get to 200 billion AUM, $1 trillion under advisement, can anybody else that's not of that size emulate any of what you did at that point? Like if there's $1 billion IA watching, or even $7 or $10 billion IA, we're going to have Sean McGillivray on the show later from Kingsview. Can they learn from that model, or did you take that model, take it to its max, and how much room is there for others in the ecosystem to do such a thing?
Oh, I think there's tons of room for others to emulate it in their own way.
Okay.
Like I would never copy somebody else's model, because it's unique to how we built the firm and every part of the firm. So the way we do deals is very specific to the Hightower model. Now, are there lessons to be learned from it? Absolutely. And there's no reason, the $1 billion RIA out there watching this can't become the next $25 or $50 billion RIA. Mm-hmm. Now, you have to be willing to pay the price for that, which is invest in the right areas to do it, find a way to grow that really fits you, because our growth has not all been M&A. That's the part that gets the most attention.
Yeah.
But it's really, at the end of the day, we're all about serving clients obsessively. And if you serve your clients really well, you get client referrals. And if you get client referrals, you get new clients. And so first and foremost, that's where we focused on value creation, is continue to win and get new clients to the firm.
Now, when you think about right now the kind of the hot ways that RIAs are either growing or kind of pushing for client growth too. You hear a lot about private investment. You hear if you're smaller, you can go on TV, you can do a bunch of TV, you can get popular that way. Or you can have products that really stand out. And that's where I think some of this options-driven stuff comes into play. To what extent did you think about the product side, and is there a way today for these people to kind of use some of these avant-garde things, or is it more just about the personal relationship with your clients and showing that, hey, I'm going to be able to talk you down during crazy times, or do you need to have something hot and sexy?
Yeah, I think it's about all of it. Now, first and foremost, everybody thinks they're growing right now because the S&P is through the roof.
Right.
So don't kid yourself.
Easiest way to grow AUM is stock market to go up.
Well,
right?
That's right. But then what are you really? You're just an index fund. So don't kid yourself. Be really honest about, are you growing? Are you winning new clients? Are you getting additional share of wallet from your clients? But to your point, it really is the total package. So you need to have a niche. You can't be all things to all people. So you got to figure out, what are you going to be known for? And maybe that is incorporating a product or a certain, strategy or concept that's uniquely you. Options is a great area to differentiate, because I would tell you most advisors don't do a whole lot there. It's complicated, but it can also be an incredibly effective way to hedge portfolios, generate income. So that is a great way. But I think it's the totality of the niche you choose to serve and how you choose to serve it, which creates the differentiation.
The private stuff, is that an organic place that we're going because the underlying assets are really good and work for everybody, or do advisors just need something that they can attach a fee to that people don't already got in their portfolio?
Yeah, I think, hey, we'll wait and see how this all plays out. But I think all of us in the business expect the use of privates to go way up. And it was one of the reasons you had mentioned the acquisition of NEPC. One of the driving forces behind that decision was their capabilities around private markets and alternatives, and to put us in a better position to leverage that, because our clients are asking for it. So we definitely see those allocations growing quite substantially over the next few years.
We had someone really interesting on last week, Drew Miyawaki from Westwood, and their solution is to create public assets that kind of mimic what's in the private world to replace some of the liquidity issues. Are there ways to brush over the liquidity problem? Because that's kind of what you hear a lot about as being the downside, the negative of private assets. Is that an issue, or do markets just, as long as they kind of keep on the way they are, don't worry about having to take your money out?
Well, I think you always have to worry about taking your money out, which is why at the end of the day, you have got to be very mindful of what's right for your client. Because if your client is sensitive to liquidity, you shouldn't be over allocating in private markets. And the more those products try to create liquidity, then they're actually impairing the reason you're going there in the first place, which is hopefully to drive additional returns that maybe you don't feel you can get in the public markets right now.
Is all this ultimately, is the private kind of a solution to try and jolt people out of the 60-40?
I don't know if it's that per se. I think it just represents an incredible opportunity when you look at the majority of companies in the U.S. are private. So the ability to give clients access to a whole new world of investing, and especially around some themes we think are really prevalent, it's attractive.
Mm-hmm. When you're looking at private assets going into the portfolios of clients whose advisors are saying, hey, this is what we think you should be in. But then if those advisors are in a larger RIA that's got a private equity investment, how do you make sure those things don't get entangled in a way where there's conflict of interest or double dipping anywhere? Is that a problem?
It's a real issue. Is it a problem? It's only a problem if you're not paying attention to it.
Okay.
So, Hightower has a private equity investor behind it. We're very mindful of not, crossing that over in a way that we think isn't appropriate for clients. And where we have made an investment available, the disclosures are really, really clear. Okay. And we're not double dipping on fees.
How many $1 trillion plus RIAs do you think, how much room is there for those? How much space is there on the map?
Well, think about 20 years ago, we didn't think much about $1 billion RIAs. Mm-hmm. We certainly never imagined $100 billion RIAs. So I think there's room.
Yeah.
I think there's going to be a bunch of firms that get to that number. Now, it probably doesn't happen the way it's happening now, meaning you're going to need big firms to start to merge with big firms to get to those numbers.
So that would kind of beget the question is, are we going to see a multi-trillion-dollar combination? Are we going to get to that point? Is that where this is going? Or is there another route, which is public markets, where then the IPO, because I know there was pressure on Hightower at least a few years back to also think about IPOing.
Yeah, I think capital strategy is very unique to each firm. Now, what we have seen is the public markets haven't fully embraced these models, and I think some of it is they just don't really understand them. So we've seen some of the companies in our industry that were public go private again. So we're going to need somebody to go do it and show they can do it successfully for others to want to follow suit. But I think back to your earlier question, I think you're absolutely going to see big firms combine because they're going to look at the synergy value of doing that. And that may be the combination that then leads them to go public. So I think the next 3 to 5 years are going to be really interesting because the industry is still really fragmented.
Yeah.
It needs some more consolidation. I mean, we've got 16,000, just using round numbers, RIAs out there. That's a big number.
That's a lot. As I've learned, it's a very complex, convoluted kind of ecosystem too. Bob, I want to also talk about the other things you're doing too, which is one of the projects you told me about that you're on the board of as well is lending-based securities lending, right?
Yeah.
Tell me about that.
Yeah. So since I left as CEO of Hightower, staying on that board, I've been able to now get involved in some other things. One of them is a local Chicago company called
Supernova, right?
which focuses on securities-based lending. So you think about it as advisors, we're very focused holistically. Sometimes we don't focus as much on the liability side of things. So, this is a technology solution that, takes custodians and connects them to lenders and advisors. So on behalf of the client, they can use those portfolios as a liquidity solution.
There you go.
And it's really powerful to the advisor because then they don't have to disrupt the portfolio.
Right.
So it's an easy way, relatively speaking, to get access to liquidity when needed.
I guess it also might answer some of the questions people have about what to do with big gains in their portfolio as well. How do they deploy that without maybe, capital gains, having to get out of position?
Which, again, gives you the advantage of being able to tap into the liquidity without selling the security.
Exactly. Which seems like one of the major themes right now as well, too, after sitting on a huge run.
It is, and I think for the RIAs, they need to pay more and more attention to this.
Supernova.
Bob,
great to catch up. By the way, Bob, one of the earliest sources of mine early on in my career at Bloomberg, I used to call you about the market.
Well,
I don't know if you remember that was a while ago.
Hopefully I had something smart to say.
Absolutely. Great to see you again, Bob.
Good to see
Thanks
you.
a lot for coming on Chicago Future Finance.
My
Great
pleasure.
stuff. Bob Oros joining us, board member at Hightower, board member at Supernova as well. Great stuff on the RIA discussion. And we're going to talk with Scott Bauer. We're going to look at the risk radar as well, getting a little market thought as we're now at 246. So I think we just pull up that risk radar and then get Scotty on here because we got Sean McGillivray just joined us over here as well. Going to talk some more RIAs from Kingsview. Let's look at that risk radar. We got, I think, a pretty important development here for crypto over the weekend with BTC taking a little hit, a little give back. Mr. Bauer joining us on the line with the beautiful Colorado view. Switching gears back into the intraday stuff here for a sec. Scott, stocks seem okay today, but on my risk radar, I shifted crypto a little bit more negative. Not red yet, but it's like in that in between where I'm looking at the chart, wondering if things going to break down here. Give me your take.
It certainly looks like it might, but if we look back at the history of Bitcoin, Ether, crypto, when there's been a big announcement or a run up to a big announcement, like, all of the buying that we saw ahead of the ETFs coming out, when that announcement actually happened, we've seen sell-offs in the past. So on this big run up that we saw Friday, and now we're seeing, a huge give back. I mean, Bitcoin 125 down to 110, that's huge. Ether 49 almost down to a low of 43. I know that's up a little bit. I think that, there's some caution out there. The spot flows have softened. ETF redemptions have picked up. So near term, that makes me a little bit cautious on Bitcoin here.
Do you think that there was just kind of a baked in assumption that Powell would start to sound a little dovish, or Do you think the MicroStrategy trade is starting to weigh on this thing? If people are just thinking Saylor's going to buy it all up, like, because one of the reasons why I think Bitcoin actually was kind of stable was because MicroStrategy is now the wild animal, on the loose, and so people.
Well, that's
just,
unfortunately that's unfortunately, for the fundamentals of Bitcoin or crypto. That's not a great thing that they're the wild thing on the radar there. So I think there was just so much pent up anticipation of what Powell might say. Finally, maybe getting that narrative that rates are coming down. We saw some euphoria there, and unfortunately, it couldn't hold. But if you do look at Ether as opposed to Bitcoin, that is making a much better comeback from the weekend sell-off. But I would still be really cautious on Bitcoin here. I mean, we dipped below 110. 107 is really a critical level to watch for Bitcoin here. And if it breaks that, we could really get back into the 90 handle here. But I don't think that's going to happen, Oliver.
I have ad nauseum talked about the bearish divergence in Bitcoin, which is still very much there. The RSI that I like to watch, lower highs. And I said, look, if that thing gets resolved in a bullish way, then it's hugely bullish for Bitcoin. It hasn't been resolved. But ETH, to your point, the momentum trajectory looks very different. So I do think there's something to be said about that dispersion between those two that's starting to show up, which is interesting because, I mean, they're supposed to have some different utility. But ultimately, I feel that if you are kind of looking for the beacon, the light on the shore, it's usually still BTC, which is why that bearish divergence, I don't know, it's getting close to like, this thing breaks down to your point, then Saylor's not too far away. I mean, his break even's like 75.
75, right.
A traditional like down cycle in Bitcoin, that's very much, within the realm of possibility.
Certainly it's in play, and Ether has had a big catch up. The Bitcoin dominance ratio or data point that people look at, which is how much of the entire crypto market Bitcoin is, that has obviously come down as both Ether has risen and altcoins. Some of the altcoins are really hanging in there right now. But again, I look to what's happening on the street here, and liquidations from Bitcoin ETFs are massive right now, while Ether ETF is still seeing a lot of inflows there. So you may just have a lot of institutional people out there that were taking profits off of that, new record of 125 or so. But again, I would agree with you. The charts for Bitcoin, I wouldn't say they're bullish. That's for sure.
The other thing that I changed on my risk radar just marginally was the dollar as well, which I was surprised at how hard the dollar bounced back yesterday. Now the dollar's cooled off again here today. It's down 23 bips, but it's now looking maybe like it's going to go green. So it was yellow before, but I'm shifting that down because you've got kind of an up channel in the dollar now going back to July. Just curious if you got a thought on that, Scott, real quick.
Sure. So if you look at that relationship, while the dollar's been getting hammered for the last 6 months or so, what have we seen crypto do? What have we seen Bitcoin do? So there's that divergence there, and now that maybe there's a little spark, a little momentum behind the dollar, that could be a reason for people to liquidating some Bitcoin as well.
Yeah. It's not really the way you would think it would be going if we're going to go on this big cutting spree, the dollar finally finding its legs, but it just got destroyed for months. So sometimes things are a little topsy-turvy. Good stuff. Appreciate it, Coach. Thank you.
Thank you.
Got it. Be right back. I got Sean McGillivray joining me from Kingsview to wrap up the conversation on advisors. Great one coming up next. Good. Welcome back to Chicago Future of Finance. Our last conversation continues our discussion about advisors, growth, finding an edge over the competition here in the great city of Chicago, where we've got a pretty action finish to the closing bell here. A little noisy behind us, 5 minutes left.
Yes.
Sean McGillivray joins us from Kingsview Partners, COO,
Yes,
former
sir.
CEO.
Yes.
Sean, thanks for being here.
Nice to have you.
So you're in Oregon, but I've known Kingsview folks here in Chicago. I know you guys have a big Chicago presence. So tell me about, firstly, where your company breaks down right now.
Absolutely. Kingsview Partners, we're headquartered in Grants Pass, Oregon, Southern Oregon, but our asset management division, where we manage a little more than $3 billion in assets across our SMAs and our ETFs. Those ETFs are listed right here at the CBOE. 7 of them has always been headquartered here in Chicago. Got about 20 folks here in downtown, just 2 blocks down the street.
There you go.
Yeah.
What's the main priority within those different business lines right now? Because what I've seen is if I look at a chart of your AUM, it goes whoop like that, and you're at about $7 billion right now.
We had phenomenal growth. Partner recruitment's been strong. There's a real desire amongst broker-dealer affiliated advisors to unlock fiduciary freedom. They want to look at fee-based. Their clients want to have someone that has their best interest in mind, has a fiduciary background, has level pricing, competitive pricing, and then comprehensive services. So you look at Kingsview Partners today, we've got wealth management services, we have asset management services, we have trust and estate, all under a fiduciary wrapper.
Okay, and bringing that in the very plain language version of the broker-dealer association versus the fiduciary. For if I'm a client, if I got money and I want to put it to work, what does that mean for me?
Yeah, think about a major wirehouse, something that's a bank or a brokerage that you know today. Won't say the names, but we all understand where they're at. They're on every corner store or every corner of a major city, or they're in the shopping mall that might be in your local regional market. They're advisors that have been affiliated, captive, have one sell. Maybe they get control on what they have from an independent standpoint.
They're kind of forced to reach into their own basket.
Correct, exactly,
things, right?
Exactly. And so there's been a desire. I'll give credit where credit's due. 2015 unlocked the idea of fiduciary with the DOL coming out with a fiduciary rule. While that never was ultimately implemented, and we had other versions of that ultimately come into effect, the cat was out of the bag. Clients for the first time were like, wait, my financial advisor doesn't have my best interest, or maybe he's not legally obligated to have my best interest in mind. All of a sudden, we had this huge pickup in the fact that RAAs were the thing from day one that started as a fiduciary, ends as a fiduciary.
We had Bob Oros on earlier.
Yep.
Hightower,
Amazing
biggest
shop
in Chicago.
Yep.
Big. Gave us a great conversation, great details. But you can hear somebody say that when you get that big, it also kind of starts to resemble some of the giant financial institutions. What's your advantage as kind of the more nimble shop?
We're absolutely middle market. You know, every aspiration to get as large as the Hightower, they've done a phenomenal job. And an amazing Chicago-based company, an RIA. This is a huge market, right? You recognize there are 300,000+ financial advisors serving 300 million Americans. 100 million plus of those are investors in the markets that we see every single day. So there's not a shortage of opportunity in what we do. Where we've had just tremendous success is working with the mass affluent, the advisors and the clients, middle America, tier 2 markets, who are often underserved and overpriced.
Underserved and overpriced.
Yep.
When you read about kind of where you're getting other advisors from, you kind of see patterns start to build. How do you get that competition in the edge? When you find somebody that you're interested, how do you say, okay, here's what we got, here's why you come over here, and then you do go back to the well? What is that kind of competition like? Because there's folks that want to do the same thing that you're doing, that want to see that growth once they get to $1 billion, and they go, well, how do I get from bill to 7?
It comes down to efficiencies and scale, right? There are approximately 15,000 or so registered investment advisors in the United States. The vast majority of them are less than $1 billion, and more of them are less than $500 million. Lots of mom and pops, regulation, technology. These things are pushing the mom and pops, the legacy advisors to move into the aggregators, things that look like Hightower, look like Dynasty, look like Focus Financial. We see our opportunity, again, an overlooked segment of the market is the mass affluent broker-dealer. The folks that are running essentially fee-based practices in a captive environment, serving middle America, great investors with a great value gap that can be closed, and that can be uniquely served by Kingsview.
Are there particular products, or are there particular ideas that when you present them to these clients who are thinking about, who have maybe started to warm up to the idea of moving away from their kind of big long-time advisor, they go, ooh, interesting. Like, what is that kind of
It literally level sets with a fiduciary foundation. When
Yeah.
you can take an advisor who's a CFP, for example, who has fiduciary responsibilities, but maybe can't execute those fully in a broker-dealer environment, be unlocked and be independent from that approach in an RA for the first time, and kind of level set that transaction with that client, it changes the attitude. Now the client goes, all right, everything that is coming out of this advisor's mouth, I know that he and the firm are aligned for my best interest.
Okay.
That's step one. Step two, we've partnered with the CBOE. That's where our exchange traded funds are, the Monarch funds, along with Kingsview Investment Management, our SMA model line. That has been an amazing game changer. 30 plus portfolios designed around the needs of the average investor.
And that's kind of the crux of where I wanted to bring it back to SIBO is how does what's happening here, the options market, the willingness to kind of push it to find edge, to extend beyond just being a benchmarked index kind of approach. What's interesting to you product-wise? What's interesting to you investment and strategy-wise?
We've been real early on. So with the ETFs and the push towards ETFs, if you look at what we've done, we're utilizing index-based, so passive index-based ETFs, but they're custom.
Okay.
They track an index that is represented by our SMA models.
Okay.
And so what you end up getting is an active ETF with the pricing, transparency, and dependability of an index ETF.
Okay.
It's been extraordinarily successful. You can then build out and replicate an index. The index can be something that an advisor and then a client can rely upon as far as evaluating those indexes.
Okay.
But maybe the overall performance data isn't necessarily there yet.
So they don't have to be out there trading individual stocks
Correct.
on behalf of their clients. You say, hey, this is kind of, is it a systematic, quantitative, or is it built for each person?
It's not built for each person. I'm not a big believer in the idea of personalized portfolios.
Okay.
Ultimately, you've got a handful of the best ideas. You want to represent those to as many clients as you could possibly get. They don't need these individual slices of this. They need your best ideas appropriately applied to their risk tolerance.
Okay.
And you look at the ETF wrapper and you look at the active nature that comes with a custom index and the create redeem mechanism that exists for the tax efficiency, they're they're unbeatable.
Is there, we had Jeff Chang on from Vest earlier. How do you feel about the buffered or target outcome style stuff? Is that more for clients that just don't want to lose, or do you feel that it has an important role?
I think we're still understanding what that role is going to be. These are early days for all the defined outcome, all the buffered products. They have not been truly time tested in a lot of market volatility, and this market and our markets in general have an uncanny ability to find weakness in a product and exploit it. So we don't fully understand what they are going to do in all market conditions. We can look at some past data. There were only a few of them trading around the COVID crash,
Right.
but we can start to understand how they could be part of an entire allocation. We, in fact, run a set of portfolios called the tactical asset management models that include buffered ETFs along with some of our tactical strategies.
Got it. Anything tactical that's particularly strong you want to tease?
Right now, our current strategy, VFGU, which is the Volume Factor Global Unconstrained ETF, is a global allocation utilizing a tactical edge. You can check it out at monarchfunds.com.
Nice. I was yesterday online. I was doing a Twitter Spaces, and I was talking about the international trade because it's still killing it on the air.
It has absolutely killed.
All these guys are talking about all the calls they're buying, all the tech stuff. And hey, great, fine, they're working okay. But if you go benchmark the broad world, still doing better. I mean,
the blind squirrel finds a nut once in a while.
Sean, great to meet you. Thanks for being here.
Thank you for having it.
Good conversation. Sean McGillivray joining us from Kingsview Partners. All right, that's it. We heard the bell. It cooled off here. Thanks for tuning in to Chicago Future of Finance. It's a fun show. Great guests. Maybe some of the timing sometimes is a little different than the previous day, but we're making it happen. Thanks for tuning in. I'll see you tomorrow, 2 to 3 p.m. We've got another great slate of folks joining us. Central Time, 1 hour into the close, Tuesday, Wednesday, Thursday. I'm Oliver Rennick. Have a great night.